Many people ask me the real secret to building massive wealth, and I always tell them the exact truth, but nobody wants to believe it. They prefer the flashy lies and the fake gurus selling overnight luxury, while the real money is made by being incredibly boring and unimaginably patient. Right now, we are witnessing a massive structural crack in the global bond market that most regular retail investors are completely ignoring. Our current fiscal situation looks exactly like a 350-pound two-pack-a-day smoker sitting on an intensive care unit table. The United States federal budget has officially accelerated down a completely unsustainable path for the first time since the absolute peak of the great financial crisis of 2007. The government is forced to pay over 5% interest just to borrow money for the next 30 years. A lot of people are going to end up completely broke because they refuse to look at the numbers, and they are going to panic when the cycle turns. What is up, you guys? It is Graham here, and we need to have an honest talk because this data is getting pretty bad. We are entering a world where the single safest investments in America are becoming the biggest fundamental threat to everything else in your portfolio. Keep in mind that for the last 15 years, our entire economic machine was built on the artificial concept of incredibly cheap money. Homes became wildly expensive because people could borrow millions of dollars at next to nothing. Stocks pushed higher and higher because there was literally nowhere else for institutional capital to find a decent return. But now that entire easy money system is aggressively reversing and the equity market is facing a massive mathematical problem, why would any massive pension fund or rational investor risk billions on volatile stocks when the government guarantees you over 5% to do absolutely nothing? That is why we need to break down exactly why bond prices are collapsing, why 5% is the magic threshold that breaks things, and how this affects your job, your house, and your net worth. Every single unnecessary dollar you spend on stupid consumer items is a loyal worker you just fired from your wealth-building army. Before we look at the historical data, let us strip away the snobbish financial jargon and explain exactly how this bond mechanism actually works. Anytime the United States government needs more cash to cover its massive overspending, it issues what is called a Treasury bond. This is essentially a piece of paper that says, lend us your cash today and we will pay you a fixed, consistent interest rate every single year until we return your principal. Historically, this has been treated as the ultimate risk-free rate of return because the federal government can always just print more currency to avoid a legal default. Because of that absolute safety, massive institutions, central banks, and regular retirees use these treasuries as a safe place to store trillions of dollars. Except right now, global bond prices are experiencing an absolute historic collapse. To understand why, you need to realize that bond prices and bond yields move in completely opposite directions like a financial seesaw. When global demand is incredibly high and everyone is rushing to buy bonds, the market price of those bonds goes up, which pushes the actual yield down. But when investors start dumping government debt in massive blocks, the market price of those bonds crashes and the yields instantly shoot into the sky. If that sounds confusing, let us do some simple math that anyone can understand without a fancy finance degree. Imagine a standard government bond costs exactly $100 and pays you a fixed $5 in profit every single year, which equals a clean 5% return. If a massive wave of panicked investors rushes to buy that exact bond, they might bid the price up to $125 for that exact same $5 profit. Because you paid more money for the same fixed return, your actual yield drops down to just 4%. Now let us flip the script and imagine that global demand completely evaporates and nobody wants to hold that government paper. Investors will now only agree to pay a discounted price of $80 for that exact same $5 cash flow. Because you bought the asset at a major discount, that same $5 payment now works out to a massive 6.25% return on your capital. So anytime you see a terrifying news headline stating that Treasury yields are spiking to multi-decade highs, all it really means is that global investors are aggressively dumping government debt. They are demanding a significantly higher payout just to lend their money to the United States, because they sense long-term structural danger. This is the ultimate macro warning sign, because when the safest borrower on the planet suddenly has to pay massive interest costs, everything else in the economy has to adjust. Once big institutional players can lock in a guaranteed risk-free 5% return, they start looking at other assets with an incredibly critical eye. They start asking themselves why they should buy an overpriced technology stock trading at a ridiculous valuation multiple. They start asking why they should take on massive leverage to buy commercial real estate or lend capital to a struggling startup company. When enough smart money simultaneously decides to sit on the sidelines and harvest a guaranteed 5% yield, asset prices across the board begin to fall. Unfortunately, what we are seeing today is just the absolute tip of a massive fiscal iceberg, because the United States is the largest single debtor in human history. When Treasury yields spike higher, it becomes exponentially more expensive for the Treasury Department to maintain our staggering national debt. When old short-term loans mature, the government cannot actually pay them off, so they are forced to refinance that debt at these current higher interest rates. This creates a vicious feedback loop where they have to borrow more money just to pay the interest on the money they previously borrowed. This carries on over and over again in a quiet spiral until something in the financial plumbing violently snaps. The only reason bond prices are falling right now is because investors are no longer willing to accept the low returns of the past decade. A few years ago, earning a clean 3% yield seemed perfectly acceptable because inflation was completely quiet and predictable. But today, global investors are looking closely at massive deficit spending, historic debt numbers, and three specific macro forces hitting the market at the exact same time. Force number one is the sudden and aggressive return of hot inflation numbers. The latest headline consumer price index just accelerated to a hot 3.8% year-over-year pace, which is the highest reading we have seen in years. Even worse, the producer price index, which measures wholesale inflation before it ever touches a retail shelf, just skyrocketed at a stunning 6% annual clip. This means manufacturing costs are rising rapidly, and businesses will eventually be forced to pass those exact costs directly onto you. Force number two is the global energy market, where severe international conflicts have pushed crude oil prices well past $100 a barrel, with critical shipping straits facing major operational disruptions. Energy prices are projected to stay higher for a very long time. Higher oil prices do not just make it expensive to fill up your gas tank, because energy costs flow directly through every single layer of the modern supply chain. It makes trucking more expensive, it drives up agriculture costs, it increases manufacturing expenses, and it pushes retail prices higher. Force number three is that the Treasury is absolutely flooding the global market with an endless supply of newly issued debt. The United States is currently running a massive structural deficit of roughly $2 trillion every single year. We are consistently spending significantly more capital than we actually bring in through tax revenue. To keep the lights on, the Treasury has to constantly auction off massive amounts of new bonds to raise cash for bills we cannot afford. To make matters worse, Japan, who happens to be the largest foreign holder of U.S. debt, has significantly less incentive to buy American treasuries today. Their own domestic bond yields have just climbed to the highest levels in modern history, meaning Japanese capital is staying home when fewer international buyers are willing to absorb an endless supply of U.S. debt. Yields must increase to an aggressive level that finally coaxes buyers back into the room. But these higher yields put massive downward pressure on the stock market, the housing market, and the federal budget itself. This is the exact line where a standard bond market correction transforms into a full-blown systemic crisis. This macro anxiety is also the exact reason why alternative digital assets like cryptocurrency have suddenly entered the mainstream institutional conversation. When people start questioning the long-term stability of a fiat currency system burdened by endless debt, they naturally look for assets completely outside the traditional network. To survive this shift without losing your mind, you have to understand how these exact cycles played out in previous financial history. Let us look back exactly 30 years to the great bond market disaster of 1994. Back then, yields were historically low, inflation appeared to be completely under control, and regular investors assumed everything was perfectly fine. But the Federal Reserve suddenly adjusted policy and started raising interest rates much faster than anyone anticipated. That sudden shift caused the global bond market to experience an absolute multi-billion-dollar collapse. The yield on the 30-year Treasury spiked from under 6% to well over 8% in a matter of months. Mortgage rates instantly jumped by 30%, and bond investors lost over $1 trillion of paper wealth. The craziest part of that historical event is that absolutely no one saw it coming until it was already happening. We saw another version of this play out during the regional banking crisis of 2023. Back then, yields briefly crossed above 5% because investors grew incredibly worried about sticky inflation. That sudden spike left traditional banks holding massive unrealized losses on older long-term bonds they had purchased when interest rates were near zero. The stock market fell by over 10% in a few weeks, while specific banking equities collapsed by 50%. But historically, 5% has always acted as a solid macroeconomic ceiling, where yields eventually stabilized and things returned to normal. The terrifying concern among institutional traders today is that 5% is no longer the ceiling. They are deeply worried that 5% is about to become the permanent floor for interest rates. If 5% becomes the structural floor, there are four very serious economic consequences that every single retail investor needs to understand. Consequence number one is the official arrival of the government debt spiral. The United States is already spending over $1 trillion every single year just to pay the interest on our existing national debt. Every single 1% increase in bond yields adds tens of billions of dollars to that annual interest bill. This massive interest expense completely crowds out productive government spending, and makes the annual deficit wider. A wider deficit requires even more bond issuance, which drives yields higher and makes the debt spiral spin even faster. If the Federal Reserve tries to save the day by cutting interest rates prematurely, they risk triggering a massive wave of runaway hyperinflation. That inflation would inherently push long-term yields even higher. Either way, which means the central bank is essentially trapped. Consequence number 2 is that the stock market is going to face continuous valuation pressure. Let us look at the cold, hard psychology of a rational investor. When the federal government is willing to pay you a guaranteed 5% return to sit on your couch and do nothing, stocks look a lot less attractive. The historical average return of the broad stock market is around 7% after inflation, but it comes with massive volatility and sleepless nights. There is significantly less incentive to risk your hard-earned capital in a turbulent market when you can get a guaranteed 5% with 0 sleepless nights. This environment hits high-growth technology companies the hardest. When interest rates are high, the present mathematical value of a company's future cash flow shrinks drastically compared to a guaranteed dollar you can lock in today. Consequence number 3 is a permanent freeze across the residential housing market. Anyone who purchased a home over the past 2 years and locked in a mortgage rate above 6% is likely underwater once you factor in transaction fees. Meanwhile, anyone who was lucky enough to lock in a 3% mortgage years ago is absolutely refusing to sell their home. Moving to a new house would mean giving up that beautiful low rate and taking on a new mortgage at 7%. That single choice would instantly double their monthly housing payment for the exact same size house. This dynamic completely locks up housing inventory, keeps retail prices artificially sticky, and makes it incredibly difficult for first-time home buyers to enter the market. Consequence number 4 is a slow and painful grinding halt across corporate America. Higher borrowing costs mean that average companies are forced to delay long-term capital investments and put a freeze on corporate hiring. As their interest expenses rise, their net profit margins compress. The economy does not just break in a single evening like a Hollywood movie. Instead, it slowly grinds to a complete standstill while the mathematical probability of a severe recession quietly ticks upward with every single basis point increase. So what does this actually mean for you, your money, and your personal investment portfolio moving forward? With Treasury bonds now offering a clean, risk-free 5% return, I know a ton of people are wondering if they should just move all their cash into bonds. My honest perspective is that if you are a retiree or someone saving short-term for a down payment on a house, earning 5% is an incredible deal. It provides a safe, stable, predictable buffer that protects your liquidity from short-term stock market crashes. However, you must understand that over a long 10 or 20-year time horizon, that 5% yield will likely get eaten away by ongoing inflation and money printing. Treasuries are fundamentally designed to preserve existing capital and generate a little bit of extra income. They are absolutely not designed to maximize multi-generational wealth. Stocks have historically outperformed fixed income because you are being heavily compensated for taking on the additional asset risk. If you get terrified by short-term news headlines and move too much of your net worth into bonds, you might protect yourself from temporary volatility, but you are doing so at the direct expense of your long-term compound growth, which is how real wealth is built. You also need to understand that not all bonds are created equal. Short-term treasuries like a 3-month or a 6-month bill are essentially equivalent to holding cash. They provide maximum flexibility and carry almost zero price risk if interest rates continue to climb. But long-term bonds like a 10-year or a 30-year treasury behave in a completely different manner.